Welcome back, traders. Here are my lecture notes as we continue with ICT's 2025 lecture series. This time going over the SMC opening range gap once again. He did give an intro to opening range gap in his first lecture, but this one is much shorter and he gets into the details of this PD array to clear up any confusion. Again, my lecture notes are not meant to be a summary or a shortcut. These are simply my interpretations, and I strongly encourage you to watch his original video. I'll have it linked in the description. And before we get started, I would like to ask you to give this video a like and subscribe as we continue into 2025. Now let's get into it.
Hey folks, welcome back. All right, so we're going to be doing a very specific study on the smart money concept, opening range gap. An opening range gap, obviously, I see a lot of students with confusion. They're thinking that the new day opening gap is the opening range gap, and hopefully we'll clear that up for them today. First and foremost, you have to check to make sure that your chart is showing in the regular trading hours, not electronic trading hours. 9:30 a.m. Eastern Time higher opening price in regular trading hours is classified as a premium opening range gap. If the opening range gap is 120 handles or larger, price could leave the gap unfilled. Now, obviously, when you have a large gap like this, which is a couple hundred handles between the previous day's regular trading hour settlement at 4:14 p.m. to the opening price at 9:30 Eastern Time the following day, with such a large gap like that, the rules I employ is that it's probably going to keep going in the direction of an extreme gap like that. And if it ever, it may not even do this much, but if it ever does trade below that low, usually it's going to stop around the upper quadrant. And you can see that here. Eventually, price will want to rebalance all of this here because it's inefficient, because there's no price at all, is zero. So this is an actual liquidity void because the opening range gap is defined by regular trading hours only. As soon as you start showing electronic trading hours, what you're looking at there is new day opening gaps and or new week opening gaps.
Okay, so I'm at the 7-minute mark. I can keep going, but I figure I pause here to recap what he said so far. Nothing new just yet. Mainly, he just wants to clarify any confusion that people may have between the opening range gap versus the new week or new day opening gap. Basically, it's the gap that you're seeing depending on if you're showing electronic trading hours or regular trading hours. If you're showing electronic trading hours, then the gap you see is the new day opening gap, and that's the gap that happens between 5 p.m. to 6 p.m. Make sure you have the time zone set to UTC 5, New York time, so you can follow along. Now, if that gap is between Friday 5 p.m. to Sunday 6 p.m., then that is the new week opening gap. What he's talking about in this video is the opening range gap. To see this gap, you'll have to switch to regular trading hours, and this gap is between 4:14 p.m. to 9:30 a.m., which is the opening bell for the following market day. The opening range gap is significant because in this void, there is no buying or selling, so price will eventually want to come back here to offer the opportunity to buy or sell. However, when the opening range gap is really large, this time he specifies over 120 points, but if it's really large, the market will tend to trade away from it and leave it unfilled for the day. But you'll want to grade it because later in the day, we could trade back into it or to the 25% level, or sometimes even to the 50%, but will likely leave it unfilled and not trade all the way down. Eventually, it will want to do that in the future, but not right away. All of this has been taught before, so I'm going to go ahead and continue with the lecture.
This lower gap opening, when we have that at 9:30 Eastern, if that lower opening price in regular trading hours is appearing, then that is classified as a discount opening range gap.
Okay, I had to stop here real quick to point out two things. First, you will not be able to find this exact gap on your chart because it's not real. It doesn't exist. What ICT did here was he took the premium gap you saw earlier and he photoshopped it by inverting it, flipping it upside down to create what you see here. He's just saving some time for himself so he can show you an example of a discount gap without having to find a real world example. So the second thing, because of that, you see the zero level here is incorrect. It should be anchored to the opening price of this candle, not the closing price. Typically, his green candles are up candles and his black candles are down candles. Now, this would make sense if you reverse the colors and pretend that the green candles are down candles and black candles are up candles. So I just want to point this out if anyone got confused, but let's go ahead and continue.
And again, the classification is only determined by if it gaps higher at 9:30, that's a premium. It's a gap higher. If it gaps lower at 9:30 than where we settled at 414, that's a discount opening range gap. Okay. And the only reason that's important is it helps you determine what direction you're going to draw the fib on. But if it's 20 to 75 handles, usually if it's a premium opening range gap like this, what I like to look at with electronic trading hours, if it opens higher, I like to see it trade to a pre-market session. That means anywhere between 6 o'clock in the morning Eastern time to 9:30, all that time there. I want to see it trade to some overnight London high or relative equal highs or some high that was formed. So it's going to run buy side initially. And then I would look for it to trade back down into minimum consequent encroachment, which is the red level here, or middle of the gap. And depending upon how I'm bullish or bearish, or if I'm just trading inside of a range, will determine whether or not I'm going to look for a complete gap closure. And there's a lot more rules we'll talk about before we get to the end of this month.
Okay, so my takeaway here is that it's very important to pay attention to the size of the opening range gap. If it's a really large size, anticipate price to first trade away from it, but if it's more of an average size of 20 to 75 points, and we meet the criteria of a liquidity sweep pre-market, then anticipate price to trade into the gap at least 50%. And then depending on some other factors that won't be covered in this lecture, we can anticipate either a full gap closure or a reversal.
Now there's a sweet spot between 75 and 120 handles where it can go either direction. So I usually err on the side of what do I see in other analysis concepts that is going to help me, because I may have to just sit on my hands and wait till 10 o'clock and not trade anything at the opening. These are just general rules where I have to lean on what the market has in price, where we are with the economic calendar, and where are we at with seasonal tendencies, the current market structure. All these things have to be referred to when the range is higher than 75 handles.
I see. I was wondering about the range between 75 points to 120. Sounds like those are going to be the more difficult ones to determine because they can behave either like the large gaps or the normal size ones.
When you're looking at your regular trading hours chart, you want to highlight every gap. When there's gaps like this, the market will want to do patchwork where it'll deliver back down into it and offer price between these two defined levels, where the previous settlement at 4:14 p.m. Eastern time to 9:30 the next trading day. So here, as the market starts to sell off, look how the consequent encroachment offers another shorting opportunity. Mid gap right here, breaks down, comes back to the lower quadrant of this gap, rolls over, uses the low of the gap. So the market trades down into it here, hits the high of that opening range gap there, trades down to consequent encroachment. Look at the bodies. See how they're respecting that midpoint? Then rallies up and then breaks down. Look at the bodies respecting the low of that opening range gap. And then look at the reaction there. Rallies up, takes out the relative equal highs here, and then it's most likely going to want to gravitate towards these relative equal lows here. That's just a little too clean. Things like that, price levels like that don't usually stay intact. The smooth edges will be made jagged.
So yeah, my main takeaway from this lecture is to pay attention to the size of the opening range gap. Depending on the size, we can expect different behaviors, and also it's important to grade these gaps as the market will want to return to these specific levels, and they can be swing points in the marketplace. But that's going to be it for this lecture. Make sure to give this video a like and subscribe as I keep on sharing my lecture notes. But until next time, safe trading.